Hello. In this video, what I'm going to show is how we got in and out of two very profitable leap bull puts and bear calls or credit spreads. We do this all the time. This happened today and yesterday. So I want to review the total anatomy of those two trades. My name is Dale Brethauer. I'm a professional trader, and I currently am the founder and run a very excellent education website on options, www.optioninfinity.com. Towards the end of the video, I think if you stick around, I'm going to show you the website and explain a little bit more about that. We do focus on credit spreads. I happen to believe they're the very best way to bring in a consistent monthly income. There are a number of advantages. One is great returns when coupled with a very high probability of being correct. Like I mentioned, it yields monthly income on a consistent basis. Yeah, you're going to have some losers. You're going to have some losing streaks, but you're going to get an average monthly income consistent month after month after month. Again, there are high probability of success. With a credit spread, what we're doing is selling premium, and time is in our favor. If you buy a straight option, you not only have to be correct in the direction that it's going, you have to be correct in how quickly it's going to get there before expiration. We're doing just the opposite with credit spreads. We're taking time to our advantage. We're sellers of the premium. We never sell naked, though. We're always buying one further out of the money for protection. You don't have to constantly watch the market. It's a low anxiety way of trading, and you've got protection against the loss because we're always going to be buying one further out of the money. In this chart, what I'm showing you is the rapid decay of time premium. What we're doing is we're selling out of the money options, and the only value that out of the money options have is time value. And that time value decays quickly as it gets closer and closer to expiration. You can see in the last 30 days, it's very rapid fall off. And this is to our advantage because that time value, that premium, is decaying rapidly, and it goes right into our account. A bear call is a type of option strategy used when you think that the price of the underlying is going to drop. It's achieved by selling call option at a specific strike price, and this is an out of the money option. And then we're going to buy the same number of calls that are at a higher strike price. So that's your protection against it going way, way up. Now, the operative word here on a bear call is it's a bearish strategy. A bullish strategy for credit spreads is called a bull put. This is when you think that the price is going to be going up, and what you're doing there is you're selling a put out of the money and buying one further out of the money. The beauty of having credit spreads is you don't have to be right in the direction. It can, if you have a bear call, it can go down and you can win. It can go sideways and you can win, or it can actually come up a little bit and you can win as long as it stays below the strike price at which you sold. Same thing as with the bull put. The bull put, you can win if it goes up, sideways, or slightly down. This is the bull put spread on Home Depot that we got out of today. This was a very profitable trade, about 81% profit on credit. The chart, what you're looking at here is basically we we use the regression channel, which are these lines here. The regression line is calculated by 50% of the price being below, 50% of the price being above. So it's an excellent trend line. Then we look at plus or minus 1 standard deviation, and then plus or minus 2 standard deviations. Plus or minus 2 standard deviations shows that 95% of all price will be contained within that channel. Occasionally you do have outliers like we did with Home Depot, and what you do know is it will shortly revert back to the mean and probably overshoot that and continue on. We take advantage of the regression channel to know when to get into a trade. The other thing I look for is a measured move. A measured move is when it comes up, pulls back, it makes a higher low and then a higher high. You'll see a measured move on a bear call is just the opposite of that. And then once you have a measured move, you can put in Fibonacci's, and they help you to determine when the price is overextended. Those 3 key tools can be further explained by myself in a video that I will show you at the very end of this. There's a thumbnail that all you have to do is click on that, and I'll go into great detail into these 3 principles. The trade was put on April 17th when Home Depot was at 293. What we did is we sold a bull put. We sold the 19 June 170 put right here, and we got $6.73 for that. And we bought the 19 June 160 put, so we bought one further out of the money. We got a net credit on that of $1.68. Now, what we did is we stayed with this trade until it came up to the point where we thought the Fibonacci's were fully extended. We had made a real nice profit on that. And on May 7th, we bought back the bull put by buying the 19 June 170 put and selling the 19 June 160 put for a net debit of 32 cents. So we made $1.68 minus the 32, or $1.36 profit on a $1.68 credit, or that is about 81% profit on credit. So we made $136 on one contract, $1,360 on 10 contracts, and over close to $7,000 on 50 contracts. Now you have to mention that past performances is no guarantee of future results. The other beautiful thing about this strategy is not all of the stocks follow the market, and the S&P 500 could be going up, and most of the stocks, about 70% of the stocks, will have opportunities for bull puts. But occasionally you'll have one that's a bear call. This trade was a bull put. It was put on April 17th. And just a couple of days later, we put on a bear call on Hershey. You can see here, we sold the bear call, the 21 August 160 call for $1.64, and then bought the 21 August 170 call for protection. Got a net credit of $1.05. On May 4th, we bought this back by buying the 21 August 160 call and selling the 21 August 170 call for a net debit of 43 cents. So we took in $1.05, we bought it back for 43, so we had a net profit of 62 cents, or $62 on one contract. This is 59% profit of credit. $620 on 10 contracts and $3,100 on 50 contracts. Once again, past performance is no guarantee of future results. I've been doing this for a long time, and this is my equity curve for 2019 up until May of 2020. you can see a positive expectation and a positive equity curve. You will have some losers, you will have some losing streaks, but over the long run, this is a positive expectation way of trading. Once again, past performances are no guarantee of future results. Now, if you'll give me another 2 minutes, what I'd like to do is end this and go over to my website. It is www.optionsinfinity.com. This is, we've been in business for 10 years. We've averaged 75% winning trades over the 10-year period. If you scroll down here, you can click on this button right here to get a PDF of my 3 principal method of trading. This explains in detail exactly how I trade. Then if you scroll all the way to the bottom, you can become a member. And as a member, whenever I make a trade, I send out a text and email alert. So you will be getting, it's like looking over my shoulder. When I see a trade, I will be sending that out to you. Then it's up to you to look at that trade and decide whether or not that's something that you want to take. Once a week, we have a get together at noontime on Tuesday Eastern. If you can't make it, it's always recorded. Spend about a half hour. I teach it, and then we've got plenty of time for questions, and I review all our current trades and what I see in the future. I think this is a great opportunity for you. I hope you become a member. It's a recurring monthly fee. You can cancel at any time. And on the screen shortly, you will see a button with a D on it, and that you can push that button and subscribe to my YouTube channel. I have about 24 educational videos on there, but I'd also like you to click on the thumbnail that will take you into the part 1 of a 12-part series that shows exactly how I trade, how I get regression channels on my chart, how I get measured moves, what Fibonacci's are, and it goes over some more examples of trades. I hope to take advantage of this opportunity. Thanks for listening. Bye-bye now.